I've changed my opinion for 2023 because as a forecaster, you have to adjust. We are still at very, very low inventory levels, and they did shoot up. They almost doubled year over year, but doubling from 2021 to 2022 means almost nothing if you're wondering why mortgage rates are going down, even when the Fed is raising interest rate and there's risk of recession. This is why it's all tied to bond yield. We're just a couple of weeks into the new year, but the housing market and the economy are just as confusing as they have been over the last couple of years. We're just getting really mixed signals. For example, on one side, we're seeing inflation starting to come down, which is a really good trend, but we're also seeing retail sales come down, and we're at risk of a pretty significant recession. On the housing market side, inventory keeps going up, but mortgage rates are going down. It's really hard to get a beat on what is actually happening and what the implications are for real estate investors across the country. So today I'm going to share 5 charts with you that help you get a sense of what is going on in the housing market right now in January of 2023. Hey, what's going on, everyone? I'm Dave Meyer, Vice President of Data and Analytics at BiggerPockets. And I'm super excited to talk to you about this today. But first, we do ask that if you like this video and like this channel, please give us a thumbs up and subscribe to the BiggerPockets YouTube channel. With that, let's get into our 5 different charts that we're going to look at to help explain what is going on in today's housing market. The first one I'm going to talk about has been in the news a lot, and for good reason, because it marks a huge reversal of what was going on last year, and that is mortgage rates. So I'm looking at a site called Mortgage News Daily, and they survey some of the biggest mortgage providers in the whole country to figure out where mortgage rates are at on any given day. Mortgage rates have been dropping since about the middle of November. 1 year ago, about today, it was about 3.7%. And we're at 6.11%. So it's still nearly double where we were, but it's markedly down from the 7.22%, which is where we peaked back in November. And this is really encouraging. But as you can imagine, lower mortgage rate increases demand. More people want to buy homes when mortgage rates are cheaper because it improves affordability in the housing market. Mortgage rates are coming down, and they're on this downward trajectory that has lasted several months, which is encouraging. Why is this happening? The yield on the 10-year U.S. Treasury bond. And I know I talk about this all the time and it doesn't seem exciting, but pay attention to bond yields. They are remarkably important for the global economy because mortgage rates follow bond yields. It doesn't, it does matter what the Fed is doing. The thing that is most correlated to mortgage rates are bond yields. They peaked around November 8th and have been going down ever since. And that's why mortgage rates have fallen. And the really interesting thing about bond yields where they are right now is that they suggest that mortgage rates could actually go even lower. Normally, in normal times, the difference between a bond yield and a mortgage rate, the average on a 30-year fixed rate mortgage, is about 1.7% or 170 basis points. So if that were true, then with a bond yield at about 3.5%, which is what we're, or 3.4%, which is what we're at today, you would expect the rate on a 30-year fixed rate mortgage to be 5.1, but we're actually at 6.1% right now. And there's logic behind that. All the volatility, the uncertainty about the economy has mortgage brokers and mortgage banks, padding their margins a little bit because there's just so much uncertainty. But there is evidence, given the bond yield, that mortgage rates could actually come down even further if more uncertainty leaves the market. Let's say there's, good GDP numbers or inflation continues to go down. We could start to see that gap lessen and mortgage rates could come down even further. On the other hand, of course, if bond yields start to rise again, then we'll see mortgage rates go back up. So that is a big question mark. But if you're wondering why mortgage rates are going down, even when the Fed is raising interest rate and there's risk of recession, this is why it's all tied to bond yields. So those are our 2 indicators of demand, right? We're looking at mortgage rates. Those are coming down. When mortgage rates go down, it doesn't always mean that there's more demand. But since the beginning of the year, I've been hearing from agents and lenders that activity has picked up a lot. I actually received a message from someone in Seattle who said they had more activity at their open houses through the first 3 weeks of January than they did for the whole 4th quarter combined. So that is really significant, and I didn't know if it was true or what was going on until recently. This data, which is the United States Mortgage, the MBA, again, the Mortgage Brokers Association, they put out this thing called the Purchase Index. And this is basically how many people apply for a mortgage to purchase a home. So not refinances, just purchases. And what's going on here is you could see a big spike up in January. And it's not crazy, right? Look, it's up to 200. This is back to about where we were in October. But it is kind of surprising, at least I was surprised by this, because you see, even though things started to go down in November, they didn't really spike up this much. But since the beginning of the year, they have spiked. And, it's just 1 week, but it will be interesting to see the trajectory of this over time. If more demand enters the market, that is going to put a lot of upward pressure on the housing market. It might not be enough upward pressure to offset the affordability issues that we're having, but it is a factor that will impact housing prices. In a historical context, 200 on this index is very, very low. Normally you see about 250 to 300, pre-pandemic, it was like 225 to 250. So that's where you would expect it to be, but we're not quite there yet. But this is a really important metric to watch just because demand is so important in the housing market. And this is, I believe, the best real-time proxy for demand. Let's move on to our fourth chart where we're going to talk about inventory. So again, prices in the housing market depend on supply and demand. We just talked about the demand side. Now let's talk about the supply side a little bit. The best way, at least the way I prefer to look at supply, is something called inventory. Basically, how many houses are for sale on the housing market at any given point. And I'm looking on Redfin. You can actually get this data for free. It's really awesome. It's redfin.com/news/data center. Just Google Redfin data center. You can look at this all yourself. You can play around with it. But what you see here, inventory, so you have zoomed in on inventory, and I've adjusted it seasonally, just so you know. That basically means, housing market is very seasonal. And the best way to look at housing market data is to remove that seasonality. That's what I've done here. And you can see we are still at very, very low inventory levels, and they did shoot up. They almost doubled year over year throughout 2021, but doubling from 2021 to 2022 means almost nothing because in the historical context, we are still at just over 1 million homes for sale. If you go back to 2013, we had 1.8 million homes for sale. If you go back to pre-pandemic, let's just pick out a day. Let's just go to January 2020, right before the pandemic started, 1.4 million homes for sale. So we are still significantly lower in terms of inventory than where you would expect to be. But at the same time, because inventory is not rising at the same time, that mitigates the impact of falling demand, and it means that prices aren't going to drop that much, at least in my opinion. And of course, we could see inventory start to spike up more. I think we probably will see it go up a bit more, but the fact that it hasn't returned to pre-pandemic levels is one of the main reasons I have said and keep saying that I don't think a crash, which I'll say is more than 10% year-over-year declines in a single year, I don't think that's likely in 2023 because of these combined things. We are seeing demand recover, and we are starting to see inventory flatten off, at least at this point. The last thing that I'll show you, the last chart I wanted to show you is, of course, the thing everyone cares about most, which is the median sales price in the United States. So you can see on a seasonally adjusted basis, again, we want to adjust the data seasonally to make sure that you're accounting for these normal variations in prices. That prices have gone down. They've gone from 410,000 according to Redfin to 405,000, which is not a very significant decline over that period of time. But if you look at the year-over-year change, I think this is the really important graph here, right? So look at year-over-year seasonally adjusting home prices. You can see that they were actually up in December. They were up 2.5%. So again, not a crash because we were saying that year-over-year, which is the best way to look at housing data, the prices are still up. But look at this trend. I mean, you go from May, where it was up 24%, down to 2.5%. That is a very dramatic deceleration of price change in the housing market. And so personally, I believe given all of these factors that I just shared with you, we are going to see this trend continue. We are going to see prices go from where they are now, which is 2.5% positive, to negative, probably sometime in February or March. And personally, I think we're going to see negative home price growth in 2023, but I think it will be single digits. And just for the record, for everyone who said like, oh, there's going to be a crash, you said that they wouldn't crash. I said that during 2022, I didn't think prices would go down. And just for the record, they went up 2.5%. I've changed my opinion for 2023 because as a forecaster, you have to adjust and put time periods on it. So I said 2022 was going to be 2 to 7%. It was 2.5%. This year, I am saying -3 to -8% is my forecast for what's going to happen in the housing market over the course of 2023. So we'll have to, a year from now, go back and check that out. So that's my opinion. Hopefully this helps you not just read the headlines and say, oh, there's going to be a crash, housing's going to go up, but actually understand the logistics of what is happening, what the various factors are that impact the prices of housing right now, and allow you to do your own analysis. Thank you guys for watching. If you have any questions about this, you can always hit me up on Instagram where I'm @TheDataDeli, and I will be back next week with another video. Thanks.